Good morning, folks, and welcome back to Almus Market Mornings. This week, yet again, starts with geopolitical updates. There has been no change in strikes. US-Israel continue to hit key infrastructure, with more recently US hitting the important Kharg island. It has avoided hitting Iran's oil infrastructure up till now. There have been a few ships carrying LNG and crude that have managed to get to India, and it looks like Iran may be okay with ships carrying energy to India and China to pass. As of now, it looks like we are far from it, but if it materializes, it will release a lot of pressure from energy prices. Good morning, JK. Any specific read of the war with a few ships trickling from Hormuz? Can the pressure on energy ease?
Hey, good morning, Swaraj. No, actually, the world is now more focused on whether and how the oil flow from the Gulf is improved. And so there are two measures that the US has taken. One is, of course, as you mentioned, the attack on key island of Kharg in Iran, destroying the missile storage, naval mine depots, and other military facilities. However, importantly, the strikes avoided the island's oil export infrastructure, though US has warned that it could target those facilities if Iran continues to disrupt the shipping from Strait of Hormuz. The attack is meant to pressure them and reduce its military capability as well. Kharg Island is Iran's main oil export hub and is one of the most strategic energy locations of the world as well. Around 90% of Iran's crude oil exports are, loaded from Kharg Island. So it will not only be Iran that will be affected because of, their export stoppage, but also even China will be affected because they also get a major portion of their oil from Iran. Now, if that's one pressure point that US is applying, other is that they are, announcing as early this week a multiple cooperative effort by countries to form a coalition that will escort ships through the Strait of Hormuz. This is what the media is also reporting. In fact, President Trump has warned NATO that they face a very bad future if they fail to assist in opening up the strait. And this is what he has said in an interview. And he could also delay his summit with China's President Xi Jinping, if Beijing does not help in unblocking the crucial waterway. So I think now that has become a crucial point for the world now, although the attacks are also continuing elsewhere, not only in Iran, but also in Israel and other countries in the region. So whether there are any ceasefire efforts, there are some vague talks. Like US officials responded by saying that there could be end to the war in a few weeks. However, Iran has set out such tough terms that it's very difficult to see them getting to any sort of talks with them. So this is now the other side of the war that we are seeing. So the world is now watching both these developments, and as you said, Iran allowing ships passage to India carrying gas and oil is a big relief for our economy. Hopefully that continues to happen. But the point is the exporting countries like Qatar, Saudi Arabia, and Kuwait and Bahrain, unless they start producing, enough of those restart rather, there will be supply constraint that even we will face, even if the ships are allowed to pass. So this is uh, another angle that we have to look at. For that, Iran has to stop bombing those facilities in the region. Although they have very clearly said that they don't target any of their friendly neighbors, but they are targeting the US bases, and that is a very important point that we need to watch out for. In the meantime, on the economy, we had US PCE prices for January that were announced, and somewhat the month-on-month core PCE number. Unrounded was much higher than what it was in the previous month, almost the highest since February 2025. So I think this will be a concern for the Fed. because now this is happening even before the oil price increase has been taken into account. However, the consumer spending increased slightly more than expected, which together with the continued strength in the underlying inflation and the dragging war in the Middle East to bolster the expectation that Fed will hold the rates at the same level for several months to come now. There was a disappointment on the GDP data, which came at 0.7% from 1.4%. That was the initial estimate. For the full year, it posted 2.1% increase. Again, it was 0.1% lower than previously read. Now, private consumption increased at 1.9%. That was 0.5% lower than the previous quarter. And just to emphasize the point, two-thirds of the US economy is based on the consumption. Of course, even the private investment, or rather the business investment, also took a small hit. Now, there could be some influence on consumption and investments due to the government shutdown that happened. However, I think we need to watch the upcoming numbers as well. But no policy implication from this as well. Now, for the dollar, of course, it has stalled near the multi-month high at 100.30 to 100.50. There was a break of course 100.30, but then it was not sustained. This level has held the dollar index for quite a few number of months and quite a number of attempts. And key thing will be whether the dollar manages to break that. I think we need to see what kind of trigger will allow that to happen. Maybe the US yields going up, or the numbers from other regions come out bad, and in view of the impact of oil price, etc. So I think if it holds, then we can see a resumption of the dollar's main trend, which is down. So that if this current level at dollar index seems to be very crucial. Gold is also at a very crucial 5,000 support. There was a break of that level, but then seems to be finding some buyers there. Gold faced severe selling pressure last week as investors who have lost money in other markets like bonds and stocks have tended to take profit on some of their yellow metal positions as well. So dollar index is at a level where we need to watch what happens in the coming days, and that's very crucial. For India, rupee obviously continues to be under pressure, but the momentum of the fall in the rupee has slowed down considerably. Obviously, thanks large to RBI efforts, who have once again become consistent sellers in the dollar rupee. We are actually crawling higher in the USD INR, although it is again due to the RBI efforts. But one can also say that the market's positioning, the skew is more on the import booking, which has been quite high in the recent months, whereas exporters have taken very minimal actions once the dollar has broken the 89 levels and sustained there. And we all know that our ER valuation is 5% undervaluation for the rupee as well. So there is some sort of hesitancy. But the trend is not changed. Let me reiterate that. And if there were to be another fresh negative trigger, we could well see the key long-term target at 93.2025, which I have been focusing on. Now, on the stocks, India has already seen more than 12% fall in Nifty, 13.5% in Sensex. Some investors or analysts have started to point out moderation or some sort of a correction. The India valuations now slightly lower than the long-term averages. However, it all depends on how much the FIs perceive it to be fair value or attractive valuations. Now, just for a perspective, from October 24 till now, it's about 18 months, we have seen a net FI outflow of USD 38 billion from equities, overall about 29 billion, which means bond we had some inflows. But this compares 10-year annual average is around 6 to 6.5 plus, and 5-year average is 10 to 11 to 12 billion plus. So we are suddenly in a very large outflow scenario. which during this period of 18 months, the USD INR has also weakened. USD INR has also come up by about 11%. So clearly, the flows have influenced the USD INR to a great extent. And if we do see any relief from the war situation, particularly the oil, which has now become the major headwind for the markets, uh, we could see some retracement in the USD INR. But as of now, I'm not assuming, and one should not assume a change in the trend, notwithstanding the fact that rupee is trading at 92.50 and RBI is selling. It may continue to trade gradually higher, and RBI may continue to sell. But unless the conditions which are like flows as well as the geopolitical challenges do not change, we do not see a reversal in the USD INR. But we'll also keep an eye on the key 93.20 to 93.50 levels, from where, with further moderation in the valuation of Indian equities and the rupee at very attractive level, we could see some interest from the foreign investors. But we wait to see that. Thank you.
Thank you, JK. And yep, so if we look at the updates from the war, the key thing to look out for, even though we are very, very far away, looking at the statements from both the countries, we're very far away from a ceasefire. But there are some other interesting developments, including the passage of a few ships from Hormuz towards India. And even if, let's say, a bit of flows are allowed, then it will relieve some pressure from an energy deficient, energy importing country like India. So that's something to look out for. Apart from that, I think now President Trump is putting pressure on NATO to assist with the opening of Hormuz. So I think more and more countries are being urged to join the military efforts. We will see how all of that plays out, whether it sort of spreads the entire conflict or whether it actually helps in resolution. Dollar index, it's at multi-month highs, 100.3, 100.5. This is where, a couple of tries have happened to break higher, but let's see if that materializes this time. Gold is at crucial supports of $5,000. Last week it has been sold off continuously, and rupee is of course under pressure. Higher oil prices don't suit us. At the same time, if you look at the performance from the stock indices, FIs have been continuous sellers, so that puts further pressure for a flow-dependent currency like the USD INR. That's it from us today. Thanks for listening. We will catch up tomorrow with the fresh round of updates.